Good afternoon, everybody. I decided to bite the bullet today because I'm involved in insuring global forests. And I've been coming to the States and North America for the best part of 30 years, and I hear the same thing. Nothing, it never changes. It's, insurance is far too expensive. Far too expensive. That hasn't changed. I'm sure they have schools for children saying, what is insurance? It's far too expensive. I'm sure this is what goes on in the USA. And what I want to show you today is how actually expensive compared with what. So we'll examine this. It might be worth saying that I've got a couple of visual aids, but I will bring them. Thank you. Being coached from the back how to hold a microphone. I'll bring them out. I'll bring them out later. So that's the premise. It's far too expensive, and then they say, well, of course, everything. The rate of loss is about 0.5%, so we can afford that, can't we? But we heard a great phrase in the earlier session: you can't manage what you don't measure. And today it's all about measuring risk. And I'll toss something else in that might grab your attention, which I learned about only last week down at the UGA conference in Florida, the new SEC rules on climate disclosure. And what's that going to do with organizations that don't know what climate is doing to their operations? So those two, bear them in mind. You can't manage what you don't measure, and you might have to declare your climate vulnerability on your investments. So hold that thought. Right, we'll make a start. Who are we? We're an agency. Like all agencies, we insure things, but in our case, we're 100% forestry. And that's a very niche place to be. And it's sort of strange that after 20 years, we're the only unit that does all this work for forestry investment worldwide. And as you see at the bottom there, our clients can be anything from 500,000 to 10 billion and located everywhere. I just flashed off that slide a bit quickly, perhaps to say, as an agency, we have a lot of other underwriters that do other types of risk, such as political risk or power stations or whatever. This is a credibility slide. On the right, you've got a map, and all those purple dots are, I noticed a couple in the oceans. I'm not quite sure what happened there. But they're all places where we have analysed forestry risk since the year dot. So we have a global experience that probably exceeds that of any one particular timber investment organisation. That, if you like, is our contribution to the sector. We've been around a long time. We've experienced a lot. We've looked at plantations, natural forests, rubber, bamboo, agar wood, teak. The whole damn thing. We've looked at it all in different places. And right at the top, I got into this actually partly with an organisation in Washington called Forestry that taught me about ecosystem services. And from that point on, I decided really that if we want to tackle this issue, this is back in 2000, we really do need to get investment into forestry for a short-term, 2 or 3 decade solution to environmental improvement. As you see, 30 countries. So quite a widespread activity. Our agenda today, I'll start with the structure of the forestry insurance market. It's quite simple, but it's much more complicated perhaps than other types of insurance. We'll buzz through a few examples of climate change impacts on forestry, and there's some really simple empirical lessons from the nature of climate on investments. And it doesn't matter how optimistic you are, my question to you, which I'll repeat later on, is how do you manage that cyclical nature of risk and loss as an investor? We'll come back to that. We'll look at insurance cover products quite briefly. Things are moving on fast, I'm glad to say. And someone might call this the elephant in the room. Self-insurance, is that a strategy? And what is the true cost of that? And finally, a the summary. Right, the international insurance market, it's very special, very niche. So it goes from your asset, it goes to a broker, and I'm going to introduce visual aid number 1. He is a broker. Have a good look at him. You'll find brokers have certain characteristics. They talk a lot, and he's just redding up on his face. And strangely enough, his name is Redding. So Daniel, would you like to stand up and just? We have no formal relationship, but he is a broker that we've been doing some work together here. There are of course, brokers of your choice, any broker you like, but Daniel has sort of committed himself to spending a lot of time in this space. So, take your opportunity to find him, or if you don't, he'll find you. So that's Daniel. And the broker just looks after the legal requirements of insurance in the country in which you're based. The broker goes to a local insurer and then that's reinsured. So local insurers in any country of the world take very little risk, usually none at all, maybe 5%. But we usually find them, put them in place, and the insurance passes through. Now, all these people talk to us about the risk. What is our calculation? What is our assessment? And so on. So it's rather strange that in the entire chain we get referred to. And if you like, a project that comes from us to a big reinsurer, such as Munich Re or Swiss Re or Cottle Re, or there's a bunch of them, if you like, if we present that, that has become, it's got a sort of kite mark of quality, because we have a consultancy background. If it doesn't hit the mark, we're not going to present it as a risk to an international reinsurer. And for a bigger risk, 400 million, 500 million or more, there will be a panel of them. So there could be 4 or 5, typically reinsurers that will share your risk. That's syndicating a risk. There is a game changer down at the bottom. This SMGA is the home where we are currently resided, and we have our own insurance capacity. Now, this is a game changer because it's significant, and we have full authority to use that capacity as we wish. We have none of the constraints of a big reinsurer that has corporate returns on capital or just flavours of the month, like don't insure in Australia. We have these sort of silly diktats. So our own capacity, we feel, could revolutionise this market and make insurance available and relevant to your own particular needs. Characteristics, that has been touched on slightly today. An idea was mentioned specifically. You know the stats. 2022, the 5th warmest year in history, 47 years since the last colder than average year. And down at the bottom for the people from the US, the chart of wildfires in the USA. And a little tacky bit of information. The number of ignitions is pretty constant. So it's not about the ignitions, it's about the size of the fires that result from them. And that's a very key point. And it comes back to the point that despite all the technology we have, forest management is key to reducing your loss. It seems to get lost in all the technology. It mustn't be. It's absolutely essential. Underwriters and consultants, we would comment on that. A few examples. We've had Hurricane, I've dropped my H there, Hurricane Ian, biggest insured loss in history. Nigeria was mentioned this morning as a $30 billion loss. We've had Chilean forest fires in the last few weeks, almost matching the 2016-17 fires. We've had Gabrielle in New Zealand and, of course, the famous bushfires in Australia. I have used high-risk territories because they produce dramatic charts and really do demonstrate the principle. But I could go to a low-risk profile country and you'd see the same pattern, but obviously not possibly quite as extreme. So here's the first example. Large forest investment, Australia. About 200, so let's say nearly 300 million. Have a look. Well, I've got 6 averages on there. If you're an investor, which average are you going to choose as a contribution to your financial projections? The 2 at the bottom, the old average annual loss, 0.21%. That's pretty good. That's a low risk for us. But what's happened since 2000? that's gone up 5 times. And that is not atypical. The average rate of loss in managed forestry is going up like that, is considerable. And that happens so much. As you see along the top, I've just split it up into stages. So for those managers that just says forest burn at about 0.5%, it's poppycock. You might as well say the moon is made of cheese. You know, it's complete nonsense. It doesn't help you at all. You have to know your risk. The other point about this, of course, is there was an extreme event. There it is, a big red column, 10% loss in that situation. And this is what I'm particularly interested in. All the sort of what we might call attritional losses at the bottom, the small ones, are for most of these companies, these are things you can stand, you can absorb. But you cannot absorb the extreme event. And they are unpredictable, and you cannot calculate how big they're going to be, because they have no known mathematical relationship with whatever's gone before. So those are the things I'm concerned about. Let's have a look at a different peril. This is hurricanes. Now, we were looking at this portfolio. You can see it on the map about 10 years ago. It was part of a pension fund. And I worked with the catastrophe department of a broking operation in London. And as you can see, we ran every hurricane since 1886 over this portfolio. We split the whole of the USA into 5 by 5 kilometer grids. I had developed the damage functions by wind speed for US southern timber and so on. And it took them a week, by the way, of computers to work all this out. And that is the distribution you get. The most staggering result of this was 1886, 4 hurricanes hit the same portfolio. I think that's an extreme event. That doesn't mean to say they all did a lot of damage, but certainly that yellow one did. The blue one also did, but just have a look at it, because most damage is on the right hand of the track of the hurricane. So that was the first thing. The second thing was how loss events, when it comes to storms, cluster. This is a natural phenomenon. In Europe, it's the same. Events cluster. And you can see clusters there. Where are we? 1882 up to whatever, a few years. Same sort of thing around 1954. And of course, we're in a bit of a cluster now. We've had Michael, we've had Hurricane Harvey, we've had Laura, we've had Ian, we've had another half dozen in between. They've all clustered since, the last 5 years? Your memory is probably better than mine. So we have a cluster of hurricanes going on, which is affecting a lot of timber investors in the US South. So it's affected us as well. But, there's a typical thing. And note, 15 to 20 years between these peaks of losses. I wonder if that's a pattern. Because hurricanes are becoming more frequent and possibly stronger, but certainly more frequent. The same thing is happening in Europe, by the way. So that's a chart of it's a cause of loss in European forests, but you can see the yellow peaks for windstorms, and a little picture of wind impacts in northern Italy. And that municipality there depended on the forest for their income to run social services, etc. Very typical wind damage. Trees are upright and then they're flat as quick as that. A bit, as somebody said, a bit like tornado damage. Typhoons the same. So everything's going up, becoming more frequent, possibly becoming stronger. So that's the world in which we live. The ForestRe Corporate Solutions came up with this stat. A 1 degree centigrade rise in sea surface temperature gives 5% increase of wind speed and an increase of 50% in destruction. First sight, it sounds absolutely ghastly, doesn't it? But actually, a 1 degree rise in sea surface temperature takes a very long time to happen. So let's put it into context. But it's still that thing. Remember, a tree invests in its roots. You get a gale over that tree, it holds on, and then it breaks. So this is why you get a sudden increase in destruction. It's the same with dams, piles, anything else. When it starts to go, it goes. Right, it's often said you have a global portfolio, you can avoid all this volatility. Well, this looks like a forest investment operation. It is actually the results of us as an insurer. So we're the other side of the coin. Here we are paying out money to timberland owners, right? That's our job. That's what we do. You can see that we're paying out 72% of all the premiums that we have received. But had I not told you that, you would have thought it was just another forest. So a global portfolio does not protect you from major losses. The volatility stands, and this is what you need to measure. We've talked about the average. The average is nonsense, so we can just pass on that. This is the bit you've been waiting for, isn't it? Insurance products, right? I'm sure. So here's some stats for you. This is the natural hazard wheel of perils that we insure. Again, I've taken it from our global portfolio over the last since 2000, whenever it was, 2008. 63% of our losses are from fire, 32% from wind, and some also rounds of frost and flood. We carry on a few more years, we might get more flooding, who knows. If we had a big ice storm in the USA that lasted about a week or more, the losses would be, or could eclipse other things. China had one in 2008, 10% damage across the entire southeast China forestry sector. After that, they started insuring. So that's the nature of loss. What about the products? The old favorite is, like most of the insurance that we all have, indemnity. We try and make good your position before the event. It's called indemnity. That's probably 95% of policies in the world. In indemnity, you can insure the gross value of your asset, or you can do what we consider, or we call, value at risk. That is to say, you strip out what you expect to recover following a fire or a hurricane or whatever it is, strip that value out and just insure what's left. The beauty of that is, when there is a loss, we don't spend weeks or months trying to measure recovery and taking that from the gross loss, and then we pay you the difference as insurers. So think about value at risk. It reduces your sum insured, it reduces your premium. We also offer coverage for all the usual things: firefighting, debris removal, re-establishment, and so on and so forth. So that's the traditional product people around the world like to get their hands on. However, technology moves on, and we're all familiar with the Sentinel satellites and its friends, and new constellations going up next year and the year after. This provides independent data. Doesn't require people like me with grey hair that have been around that's collected data. It is hourly data for the last 20 years, whatever it is. You can analyze that as an actuary and come up with a threshold that matters to you. In other words, you insure a threshold of conditions. It could be temperature and duration. It could be dryness. It could be wind speed from a hurricane and distance. Anything you like. You can tailor it precisely to your need. If you're worried about harvesting fruit, it can be for the harvesting period. You might be bothered about hail, for example, that would damage fruit. So the other advantage of parametric is that because it's independent of human hand or brain or memory or records, the lot of insurance companies around the world will provide capital for it. So if you have something that is hundreds of millions, a parametric product is probably for you, because we can probably place that. Here's an example. This is a drought product. Normally we don't insure drought because you don't know when a drought starts. It could be today, but who knows? You certainly don't know when it finishes. Think of Chile. They've got, 12, 14, 15 years of drought now. I think that's where we stand. But what this is doing is looking at temperature, wind speed, radiation, atmospheric pressure. In other words, evaporation and rainfall are analyzed for your particular location. Now, as a customer, as a client, you have to decide what level of dryness is a threat to your enterprise. If it's a tree, it's resilient. It will take a lot of dryness to kill a tree, although the number of reports of losses to forestry in the States has multiplied in recent years. When I started, we never heard about it. Drought was never a problem, but now it is. So you would look at that. That's the analysis of frequency and severity. As a customer, you'd say, what level of severity affects my business? And that's where you set your threshold. So if the drought for the period that you want to insure for is more severe than your threshold, you will receive a payment. You might not have had a loss, but you will receive a payment. We were talking at lunch, weren't we, Daniel Redding? We were talking about lunch, about the old idea of coupon insurance. You used to do it in Morocco. You or me could buy a ticket, and that ticket would give you $20,000 protection if the drought hit a certain level. You can do it for fruit. You had another example, I can't remember what it was. But, coupon or threshold insurance is of increasing interest. A typical example, building trade. You can't build when it's super hot or super dry or super cold or whatever. If you have to lay the workers off, that's a business interruption loss. That's a threshold that you can insure. You can do it with forestry. But you need to know your risks. You need to understand the relationship between rainfall, drought, and tree death. How many investors know that? I would say none. You might have researchers in university that know that, but whoever is managing lots of forestry needs to know the relationship between their enterprise performance and dryness or wetness or windiness or whatever. We have a hybrid product, It's an indemnity product. The only difference is we're doing everything by satellite. You can read this slide a bit later, but in essence, you have a fire, the forest manager in the time-old tradition will measure his loss. He'll go out and see what percentage damage, what volume of timber is lost, and so on and so forth. He'll come up with a result. Now, what we do by satellite is, of course, to measure the footprint of that loss. And I'm seeing how much time I've got. How much time have I got? All right? Right, I'll carry on talking anyway until they decide. We measure the severity, 6 minutes, 7, I can't count. Oh, 9 minutes, just gone up. So we measure the area that's been lost. You can see the insured forest is that plot there, the blue one, and we allocate a percentage damage. In this case, 0, 30 or 100. So you're sort of overpaid on some loss, you're underpaid on others, but across the band, it'll be fine. You'll get more or less the right. And what we do is we compare the satellite result with the forest manager's result. And we pay the smaller of the two. But don't worry, this is not a get-out, because if the two do not align, then the whole purpose of traditional loss assessment is to sit down and discuss why is your number bigger than mine. And you then come to a conclusion. And usually the forest manager will sign what is some sort of loss, I don't know what it's called, but loss confirmation form, and then that is what is paid. So that's a hybrid. And we're selling those certainly in the States. Okay, insurance is too expensive. That's what they all say. So let's have a look. Actually, 90 or 95% of forest owners don't insure. It's because they don't know you can, or they don't know how to do it, or the brokers don't understand it, which is very likely, except for Daniel here, he understands it. But the thing is compared with what? Of course, you save the premium, but then you might get a loss. So your loss is, in effect, a premium, isn't it? That's the money that's going out of the business. So you can't manage what you don't measure. And what we're seeing here, again, this is wildfires now, every 15 years, something like that, 10 to 15 years, you're getting a major event. And what I would say to institutional investors is, how do you sidestep that frequency of a major event? We've seen it could be hurricane, it could be fire. Ice storms, I think, are less frequent. But this is very, very common. In the UK, in forestry, we have a major wind loss about every 10 years, roughly. In France, I think the last major ones was Storm Lothar and Martin in 1999, something like that. So I think we're overdue for a big storm across Europe. Doesn't sound very statistical, does it? Overdue, but it doesn't fit in the pattern. So you cannot sidestep a gap between major losses within the rotation of most commercial forests. The question is, how do you manage that? So I said, insurance is seen as expensive, but compared to what? The losses you're going to get. So to paraphrase a political quip I heard some weeks ago, insurance doesn't guarantee the best outcome for your business, but it can avoid the worst. Think about that, right? So you're going to get a big fat loss there, but if you're insured, it's going to be less. And your toss-up is decide what that is. And let's go back to a statement I made at the beginning. The new climate standards under the SEC rules being discussed now are suggesting a disclosure of your climate impact on your investments of more than something like 1% of your value. I mean, it's not in law, but it's being discussed. That should concern anybody that's SEC registered. So we have to measure our risk, and that's what we do day in and day out. Bit of a plug for us. And here's a sort of demonstration. So, know your loss. A number of years, these claim severities could be your physical written losses, or it could be losses we've measured by satellite using burn scars and everything else, but you've got a percentage of your asset lost each year. That is 101 of risk management. Know your stats. You put it through a Monte Carlo simulation that's been around for about 30 years, and you get a distribution. You can see that on the right, mean 1.29%. The 1 in 250 event, 7.17%. How do we apply this to financial projections for your timberland investment? We didn't have a go. We just tried to visualize this. I know there's somebody doing a PhD on this very subject, but let's have a look at this. You've got the most frequent losses on the left. You've got the least on the right. Therefore, the 1 in 10,000 event, 12.59%, is right on that blue line on the right. Along the bottom, we've got the mean loss cost. Remember, that's what everybody says. That's the average. 1.29% average loss is nothing. Doesn't matter. But there's a line along the bottom. Here we have an expected risk-free rate of return. 6%, say, for US timberland, or whatever it is now. I think it's just going up at the moment. So that's what you're expecting your investors to get. How do you manage these potential loss events? We've just marked 3 out of that column. We've marked a 1 in 10 at 2.63%. This is a 100 million portfolio, so 2.63 million loss. A 1 in 50, 4.9, almost 5 million loss. A 1 in 250, a 7.17 loss. Now, 1 in 250 is based on historical data. So, it's probably not 1 in 250, is it? It's probably 1 in 50, I guess. The rate at which the climate is warming is significant. It's not one, that's looking backwards. Looking forwards, this is going to be, look at Chile. Chile 2016-17 lost something like 34% of its managed timberland in Region 7. Australia, same sort of number. It's just staggering. Just on that Australia topic, as we get to the end, is that the timberland in Australia, I forget the number, but something like, let's say, 40 million hectares, bigger than the UK. The timber loss within that was something like 8 million hectares. The managed timber lost was 130,000 hectares. I'll bring you back to the point. Forest management, by the management on the ground, is the most important tool you have to reduce your risk. And as an insurer, this is what I look for. We do checklists. We can give you papers to how to manage that. So we have people working on how do you incorporate this volatility in loss for your location. Remember, we do this for every location. It's just not Australia. It is your actual locations. We'll analyze it all and give you profiles. How do you cut your costs? First thing is that bottom blue line. Retain as much risk as you can afford. Just think, most of the time you're uninsured. So why would you not choose a big fat excess at the bottom? Any losses under that line, in this example, you retain inside. It's 1.87%. That could be a lot, actually. But the big institutions, they are looking at something like this. So if we're involved insuring something US South, they could well be retaining 2% of the value, and that's not insured. You have, of course, the extreme event, that 10.23%. Well, you don't want to insure All that because A, they're unpredictable, they are infrequent, and a compromise might be to ensure the working layer of losses that you cannot afford to lose without considerable embarrassment and declaration to your investors. And then things above that top 8% line, you can insure it if you want. We're happy to take your money, but you may just decide to let's leave that to chance. And that covers your working layer of infrequent but serious losses. And that's comparison is what you want to compare with the uninsured status. So those losses are your premium foregone. Is that a word? Your premium foregone is a cost, rather like a premium. And I think we're just about there. So that's the summary. We insure forests. Global temperatures are rising. Losses are getting more extreme. Volatility is increasing everywhere. You need possibly to have a need to declare these losses at some point. And right at the bottom, that's our average premium rate since last July, 0.38% of value. That's quite interesting. It's 0.06 of 6% return. Is that expensive? No, at this point you're supposed to say no. No, that's good value. I think we'll insure. That's what you're supposed to say. But it puts it in context, doesn't it? And of course, if you think your returns are 7.89%, as somebody said to me yesterday, then it's even less. Why wouldn't you do it? It is due diligence. It is treating your investors with concern and respect. And that's it. That's the team. Now, my second visual aid is Ming, who's standing at the back. All turn around, have a look at Ming. Ming, hold your hand up. So he's part of our team. He does he does most of the analysis and a lot of the modeling. And poor Dan, was supposed to be here, but he's recovering from a surgical operation. So that's it. That's all I have to say. I'm empty. I've got nothing else to say. Can I go?